Introduce for a second. All right. What I was saying is that I originally planned to speak about volatility in the market. When I say volatility, what I really mean is that the unexpected, the kinds of things that really drive the markets a little crazy. Or you'll start to hear those kinds of terms, crazy or insane, or it doesn't make sense, uh, from traders a lot when the market's exhibiting this kind of volatility or the kind of volatility that I'm talking about. And so when I originally had planned to do this in September, the market clearly was, it was extremely volatile, and since that pattern has continued to play out. Now, I want to make a little editorial comment here that as we're talking about as we're having this discussion about volatility, I don't expect that volatility to end. And part of that is, periodically, I think one of the drivers of volatility in the market or unusual volatility in the market is unusual behavior, or I hesitate to use the word strange or logical behavior because that's so prevalent in the market anyway, but just uh, unusual behavior. So, for example, the the right now the U.S. and other central bankers and other governments around the world are in a it's very significant campaign of intervention in the markets, and in fact, all it really is just a warmed over version of trickle down economics. The theory is that if they can bail out big business, well, that's such a political word, but if they can bail out business and the richest segment of the population by saving their investments, then this is good for the middle class and the lower class because it increases job stability. Well, the problem is that largely trickle down economics and those kinds of theories that rely on that cause and effect relationship behind saving the very wealthy to preserve the stability for the middle and lower classes, it historically doesn't work very well. It's very different than supply side economics, which is something that is sometimes confused with, which can work in certain circumstances. And so what we have is we have economists and policymakers right now really battling out this against some very bad theories and ultimately trying to fight the market. So it's, we all, myself included, we all kind of use the phrases of, the banks don't want to lend to each other. They don't want to lend to business, et cetera. The Fed says this, the Treasury says this, or central banks around the. Well, it's not so much that. It's that they don't want to lend at current rates. So because everyone's nervous about the market and you want yields when you are in the market. And as long as the Fed and the Treasury continue to try to fight this trend in other words, as long as they try to, as long as they keep trying to fight the current risk environment, meaning trying to bring the risk environment down artificially by inflating or the money supply or injecting capital into loans by buying them, etc., we're probably going to continue to see this volatility. Now, eventually it'll end, and then after a period of time, it'll come back. So it's something that we'll see over and over again, and I think that it has some really common symptoms, some of which we can see very clearly on the charts, which I'm going to get to here in just a second, and others of which we can see in as policy is formed and executed, which goes to my previous point. What I'm seeing right now is that policy is still going to be contributing to a very volatile environment. So we'll probably see a lot more of this big ups and downs, these big trading ranges. And during those periods of time, is there some things that we can look for to try to identify that volatility when those unusual events are taking place? And what kind of an effect might they have on the market? And this isn't too different than topics that we've discussed in the past. It's just a matter of scale. Now, one of the things that I want to say is this is not a comprehensive discussion on everything that anybody could ever know about volatility because it's a huge topic, obviously. But what I would like to do is maybe leave you with a few ideas. Some of the things that I look for on a daily basis that just kind of pop out to you as you're reviewing the market, and where I get and how I then turn those into some trading ideas. And I think that this is relevant, of course, to today because there's some things that are going on right now that I think we can take advantage of as well. So let's. Why don't we get started? I'm going to actually share my charts here. And if you will let me know whether or not you can see my chart, I'm actually bringing up a chart of the Kiwi dollar. Just let me know if that comes through okay. Okay, it looks like it's coming through. All right, so one of the ways in which that I identify volatility or potential periods of volatility is I'll look for and I would kind of categorize volatility as just disruptions in the trend. And perhaps I could answer a question I just got asked by defining volatility. Typically, the markets always have volatility. Volatility just means price movement. Oftentimes, you'll hear traders use the term volatility when they're talking about downside movement. That's equity traders will oftentimes talk about volatility as pretty much exclusively downside movement. Volatility just means price movement. But most often, the way that you'll hear it talked about, and the way that I'm talking about it today is when you're getting volatility that is either going to be volatility is either a change in the trend or a disruption in the trend. So, for example, on the Kiwi dollar, we had these volatility periods here in the middle of August, and then again in the middle of September, where the downtrend was interrupted and disrupted. You'll also hear people talk about volatility, and this is one of the ways in which I'm using it to describe very large movements, so unusually large movements over a given period, so from one day to the next. So I'll look at volatility and trying to identify it from a couple of perspectives. So in other words, I'll try to identify that quote-unquote disruption in the trend in three ways. I use technical indicators, and specifically the one that I use is the most is Fibonacci's. And for those of you who follow my analysis, you know that. I'll also use price patterns, and then I use events. So things that are happening outside of the market or outside of price patterns, and just price movement itself, that give me a little bit of an idea as to what's going on. And I gave an example of that where the Fed's trying to fight this trend, and it may be, I suspect it's way outside of their control at this point. But as they continue to fight it, those little events give me some information as to where I think volatility or price movement is likely to go. So let me give you, for instance, the Kiwi dollar broke out in July and began trending down fairly significantly. And at the time, what I started to do was as the market began to rally here in the middle of August, we start to look for whether or not this trend is in fact a reversal, or is it a disruption? Is it just volatility? One of the things I do is I try to keep it really, really simple and really broad. So I always apply a Fibonacci retracement. And essentially, I'm looking for the market to begin bouncing off of any one of these three Fibonacci candidate levels, which ultimately it did here on the 22nd of August and began peeling off again. So after it's clear that this new shorter trend has been disrupted and the existing trend is being continued towards the end of August, then we start to say, all right, but where is the market likely to go? And in this case, I just take my Fibonacci retracement and reverse it. So now I go from the bottom of the previous trend to the top of that little disruption, that volatility in the market. I measure it. Because what it does is it gives me a target down here where the fibs do the same thing that, Elliott wave theory, a lot of these measure moves, et cetera, do. And that is it just gives you an estimate of where the market could go in the future and where you're likely to see another consolidation, which is, you'll see that down here in these over 100 levels, so the 161 and even the 261 retracement level. And you can see that happened here in September. So, this is a topic actually I've discussed before, but I got so many questions the last time that I presented on this, which was actually last month, that I thought I would just work it into this presentation because it's so relevant to the way in which I treat volatility. And I think that it's relevant. I was excited to actually see what the market was doing today because I think it's very relevant to what's going on today. Let me show you another example. So let's say we take our retracement again. We go from the top of our previous trend to the bottom of the trend. You can see that we create these little candidate resistance bands right there in the middle as we measure this previous trend. I'll show my diagonal again. And sure enough, the market peeled off just off that very top one and began to curve down again. But where is it going to go? Well, we can do exactly the same thing. So measured from the bottom to the top of that disruption that occurred in the middle of September, and it gives me my profit target. So I treat this a couple of ways. Sometimes I'll actually put in a limit order. If I'm getting real close to these levels, I'll actually put in a limit order down here, or tighten up a stop to underneath a very significant resistance area, such as up here about 6,500 or so. But it gives us a bit of warning as to where I love one of the answers that were so one of the questions that I got asked just a minute ago was, hey, I'm a beginner, what does volatility really mean? And so I tried to answer that question a minute ago, and then I noticed that somebody else just chimed in and said, another way to say it is, this is a whipsawing market and it's harder to trade. Well, I actually agree with that. I think that it can be more difficult to trade. It's the trade-off is, of course, volatile markets have unprecedented. It's where a lot of traders you make a year's worth of profits in a volatile market. It's kind of been my experience is that when the market gets really on these big trends, it's more or less where I make the majority of my money, and then you kind of bleed out over the next while. So it can be harder to trade because it moves fast, and so it can be a little scary. Today, I think, is a great example where we've hit this level where we're anticipating that there should be. So you can see where I've measured this move to the downside, and we're sitting right in between that. These two candles yesterday and then today are cutting right in between this period where we're suspecting that there should be some volatility. So what do I do now? Well, this is, the reason why I love that comment of, well, it's a little bit harder to trade is because that's true. Anytime I know that there's some volatility or I have a strong suspicion that there is a level where there's going to be volatility, that's where I start concentrating a lot more on my risk control as well as looking for those new opportunities. So will we see another move to the upside here and begin looking for new resistance? So if we measure our trend again, let's just say we get a couple more days of this upward movement. I think that's unlikely, but you never know. Then, I've got my candidate resistance levels here again. If we start to peel off of that again, I've got another wave that I can take advantage of to the downside. So the question that I just got asked was, how do we differentiate when a currency is volatile or actually rising or falling in real value? That is a great question, and I don't know that I have a concise answer to that, frankly. And my initial reaction to it, so I want to think about that question a little bit, but my initial reaction to it is, I'm not sure if it really matters. I think that the question of real value is always a hypothetical one because it's impossible to define. And so ultimately, we kind of look at, well, what are current prices? That's representative of probably the best estimate we'll get of real value. And because it's so hard to define, that's one explanation for why prices change so much. Okay, so let's shift gears here just a little bit. I mentioned that there's three things I look for, price patterns, disruptions to the trend, that I can identify with Fibonacci's, for example, as a technical indicator. You can use, sometimes I'll look for divergences by using an oscillator. I like RSI or a CCI or even a MACD or something like that. That's also very helpful. But I mentioned as well that there are times you can identify volatility because of market events. And I have a great example. This is one that occurs infrequently, but is a very powerful signal. and is one that I watch for very closely. So I'm one of these guys who I don't know whether this is a real name that people use, but I'm a Fed watcher. I watch the Fed very, very closely. I probably spend more time watching policymaker behavior than just about anything else. So I'll watch the Fed, the Treasury, etc., more closely than any other single factor. And part of that is because in a way, they're the most influential participant in the market, and so I get a lot of cues from them. Well, when we think about volatility, and particularly from the perspective that I've been chatting about it today, it's oftentimes volatility is synonymous with the unexpected or the change. So it's, when I was looking at the Kiwi just now, I kept looking at changes in the trend. How do we tell how far that change in the trend may go? And then how far do we tell how far that change in the trend should correct to the downside? So on the Kiwi specifically, we did that twice there. And then we're getting ready to watch and see if this current change in the trend is going to give us another opportunity to do that again. But the change in price trend is not the only change that I look for. Change in policy is another one. So you can chime in if you want, but what's been the Fed's policy over the last, since July or so of last year, to put money into the market, so put money into the reserve system, or to take cash out? Well, unless you've been hiding under a rock, you know that it's been the Fed's policy to put money into the reserve system every day. A lot of money through a number of different channels, not just its normal overnight open market activities or throughout the day open market activities, but through a variety of channels. They've been finding new channels and making the existing ones bigger to push money in, right? And that's been going day after day after day after day. Well, this is great because people who are looking for volatility or looking for warnings of volatility use that information. Consistency is where we get nice, fertile hunting ground, because then the change is very stark and easy to identify. Let me give you a specific example. So on 9/24, which I'm going to, in fact, I'm going to draw a little box around it here. Okay, so on 9/24, right there, the Fed, for the first time since April, actually pulled money out of the market. And the reason why they do that, by the way, is they're trying to manage the overnight rate, the overnight target rate. And they do that by increasing or decreasing the reserve supply out there. And when they pull money out, what they're trying to do is to actually bring rates up a little bit. They got a little bit too low. Now, what that means is that the Fed just broke trend, and a significant and a long-term trend of behavior. So it gives me a big warning sign here that kind of screaming in my ear that a change or volatility is coming, which subsequently, in fact, happened very dramatically to the downside. So it's still something that I'm watching the Fed for, and they continue to do that. Now, typically we would say that if the Fed is pulling money out of the market, that's usually good for the dollar because it's associated with with them trying to raise rates or trying to bring the overnight rate up. It's too low, so they're trying to bring the target rate, or they're trying to bring actual rates up towards the target rate. So that's typically you would say, or logically you would say, that's probably going to be good for the dollar. And in this case, because the prevailing trend was good for the dollar, we would automatically opt for that. So the question is, can you please type the Fed web address in? So here's what I would suggest. I don't remember the Fed web address off the top of my head. You can send me an email. I'll follow up with you. But if you just Google Federal Reserve here or in Google, you'll get a couple of their main websites. My suggestion is, however, there's the main website for the Federal Reserve, but there's also the website for the Reserve Bank in New York. They're the ones that they've got all the good detail. They've got they've got a bunch of feeds you can subscribe to. They got all kinds of charts and analysis. Very useful website. So look for that one. You'll find if you type Federal Reserve in Google, you'll get it as the first or second result. Okay. Now. You may be asking, well, does this happen a lot? Well, it doesn't actually. In fact, the time before that it occurred, it happened right there. So the reason why we took that so seriously back then was, we had been on such a rally in the dollar, the value of the dollar. I mean, this was really, this volatility to the upside was something that had taken a lot of traders by surprise, and how high it went was also very surprising. So when the Fed broke this long-term trend of putting money into the market and started pulling money out of the market, which is logically good for the dollar, at least in the short term, we start to look for a top, which in fact was exactly what happened on the euro dollar here over the intermediate term. So you can see that, and by the way, the one of the things that I look for on a the reason why I'm so interested in the changes made by the Fed is that they're such a big market participant, and they tell you about their changes. So they're fairly transparent after the fact, that is. And so they will tell you, and in my experience, it gives you plenty of time to take action if you're trading on a longer term basis. So not if you're trading the 5-minute charts, I suppose, but if you're trading with an outlook of holding positions over weeks or even a quarter or so, you generally have plenty of time to take some action. Okay, so let me shift gears here just a little bit, because I mentioned that there's 3 ways that I might look for changes or disruptions to the trend. And, I talked about fibs and price patterns, and I talked about events, when we're looking at the Fed as an example of that. And it's one that I would put on the top of my list. But I also look at the intermarket environment. So for those of you who know me, you know that every day I probably spend more time watching the Fed and the intermarket environment than I do actually looking at the Forex, just because currencies are a reflection of all that information. They have hardly any information all by themselves. And so I'll take a lot of my cues from the intermarket environment. And interestingly, I think to Forex traders, there's actually a volatility index. And I've talked about this before, but for those of you who don't know what this is, it's called the VIX. So I'm going to actually zoom in a little bit and scroll over just a touch. The volatility index is actually a measure of volatility in equities, and the way they measure it is they equate volatility with option premiums. And the reason why they do that is that option premiums rise when there's a lot of uncertainty or fear in the market. That's when volatility really starts to kick up, is when everybody gets nervous and risk is high. So the VIX, it kind of measures this. And the way that it does this through option premiums, and then it charts these premiums essentially. And you run into, I'm going to zoom out just a little bit, and you run into this measure that's kind of moves up and down as fear declines, and then as fear goes up, and then as fear declines again, like it did in May. And we can start to look for these extremes. Now, this is something that we've talked about a lot. I talk about it on my website all the time. Every time it gets to one of these extremes, we start to look for, fear can't stay up here forever. So, we think the likelihood for a reversal in fear to become more confident, and therefore volatility or price movement to the upside in equities specifically. And then we start to transfer that information to what we know about the Forex. So, what's good for equities has been good for short yen positions, as an example. And under certain conditions, it can be good for the dollar, not necessarily, but sometimes it is. And but in particular, we love to watch it because of its relationship that it has with short yen or short yen positions. So we start to go long yen crosses where the yen is the quote. Like the dollar yen or the pound yen or things like that. And you can see this exhibited, for example, each of these periods of time, mid-November, mid-January, again in March, again in July. You can go pull those same dates where the market reversed at these real extremes, which it doesn't like to be up here of about 30 or so for very long. You can go pull these results and you can compare it to like the dollar yen, for example. But what's interesting about this is the exception to the rule. So if this is the rule that the VIX does not stay above about 27 for very long, and we start to look for a reversal, and therefore we start to trade the yen, for example. We use this to trade the yen. What about, if this is the rule, what about the exception to the rule? So does it suddenly mean that the tool is not useful? Or is there something else that we can glean here? Is this all just part of the volatility question? Is this, in fact, is the exception to the rule, in fact, as useful, if not more useful, than the rule itself? So if the rule that I've been talking about for the last year, and for those of you who've been listening to me for more than a year, you know every time the VIX goes up here, I say, oh yeah, time to go long the yen crosses, because short yen positions are looking good. So we start looking for a reversal in those yen crosses and look for them to start heading up. However, we get this big break here. So we not only stayed above 30 for an extended period of time, but then on the 29th of, yes, the VIX and the JPY do have a very significant correlation, Raman. That's, in fact, actually my point. And I'll show you exactly what I mean here in just a second. So, and the reason why they do is because of the yen's relationship with equities. That's really the connection there. So on the 29th, all of a sudden, we get the significant break in this rule. And I'm going to zoom in here just a little bit on this. So you can see the VIX really headed up into unprecedented territory. What does that tell us about fear? It tells us that fear and risk are not only at highs, but they've broken the rule. This is extremely useful for us as Forex traders, because we suddenly shift from a period of we're kind of uncertain. We're like, well, are we breaking or are we not breaking? Are we still going to reverse or not? To we're very clearly the market has changed its nature, and we need to adjust to that. So on the 29th, let's go look at the yen. And by the way, I think this is extremely relevant for today. So I'm going to actually get to a point that I think matters today a lot, because I really wish I could have given this presentation yesterday, since today is such a great example of this. But I'm going to zoom in here a little bit, and you'll notice that on the 29th, we get not only a big move to the downside here. So what that means is when risk is getting to those extreme highs, that puts short yen positions at risk, which means that the correction is going to be in favor of a long yen, which means that yen crosses, for like the dollar yen, it's going to strengthen in favor of the yen or to the downside. And of course, we get this dramatic correction, huge move to the downside. Now, and so, by the way, you can pull up the VIX on pretty much any free charting package out there, Yahoo or whatever you want to do. The one exception to the rule is if you use Google Charts, for some reason they don't have the VIX. But you can go to Yahoo Finance and just type in the VIX, and it'll give you a chart of the VIX. You can see the same things that I have. And what I would encourage you to do is to look for those major tops and bottoms. Look for the rule, the support and resistance bounces. Compare those to support and resistance bounces or reversals in the trend on the dollar yen or any yen cross, and you'll see what I'm talking about. But then the break of that rule, when the VIX is getting out beyond its normal range, is just as important. Let's go back to the VIX here for just a minute. A reading above 30 does mean high volatility, but the VIX is really relative. It's kind of relative to its own history. So yes, reading above 30 is very high volatility. That means a lot of uncertainty, a lot of fear. That typically means that the two-edged sword here is it may the market. I would agree it is quote unquote hard to trade when it's really volatile, but because that's where all the big moves are clustered, that's also where there's a lot of profit opportunity there. So it's really a matter of kind of informing ourselves and educating ourselves, which is basically my point, is informing ourselves and educating ourselves as much as possible. Now we're looking at the VIX before the equity market opens, so we don't have an update here, but I can tell you that the VIX is actually coming down off of this resistance level. And you may say, well, where's that resistance level coming from? Because it seems to be in unprecedented territory. I mean, if we zoom out here, you can see where the VIX is right now compared to its history. But in fact, this, I think, for those of you who are market historians, you'll find this interesting. If we turn this into a monthly chart, there's the VIX now up around 58 or so, and there's the VIX at that same level in 1987 in September and October. Anybody remember what was going on in September or October in the fall of 1987? That's like the big crisis that everybody keeps comparing this one to, even though they're totally different. Right, it was a market crash. And so the VIX spiked up all the way to these levels after the crash and then recovered. So as it gets up to the same, it's a long-term historical resistance level. It's just like any other instrument we would look at. What we're interested in is, well, this is another candidate level where we know that there is a high likelihood for volatility that's disruptive to the trend. So what's the trend in equities right now? Well, it's to the downside. It's to the side of risk. So we're at a resistance level on the VIX. Is there a probability that we're going to get disrupted at this level, the same level, in fact, that the market was turned back at with the market crash in 1987? Yes, there's a very high likelihood of that to happen. And I think coincidentally, by the way, it's not something we could look at on a, it's not a day-to-day basis type of thing. But coincidentally, today, I think we're going to see a very sharp increase in equity prices today. And what does that mean for the yen? Well, typically that's good for short yen positions. And so we see dollar yen and other yen crosses beginning to rally a little bit. The point is that we can take this information, including about volatility, including a volatility index itself, to start to find those periods of time where a change or a disruption in the trend is likely. And therefore, we can not only be prepared for it by limiting our risk, controlling our market exposure, things like this, but we can be ready to take advantage of it. So by making some profits. And the last thing I would say is I wanted to just get a couple of points across, get a couple of takeaways here for people to walk away with, is that right now, today, I think is a good example because we're expecting some consolidation. We're expecting a little volatility. And we're seeing other intermarket relationships throwing off these same kinds of signals. Gold, the bond yields, et cetera, are kind of throwing off these same signals all at the same time. That we're probably going to get a little disruption in the trend right now. And then we can start to prepare over the next couple of weeks for, are we either going to get a continuation, and where is that going to go? Or how far is that disruption going to last? So let me answer a couple of questions, and by the way, I'm happy to discuss. If you have follow-ups or whatever, and we don't get a chance to talk about it on the presentation, I'm happy to chat about it. You can send me an email or chat about it on my forum on my site or whatever you like. Let's see. First question. So, John, if we assume that the VIX will come down from its peak, does it mean the JPY will weaken and the carry trade will be back? I don't think so in the short term. I would suspect that we're going to get a little correction. I think right now all signs point to yes, we'll get a little bit of a correction, but a little disruption. But ultimately, in my opinion, the fundamentals are so skewed to the negative right now. Any shift is probably going to be temporary. Now, will the carry trade be back? I think so. In the long term, certainly. It appears and disappears. It's a long-term type of outlook. The pairs that you trade the carry trade with is not always the yen. In fact, when I trade the carry trade, my own carry trade portfolio, the yen is only 1/5 of my market exposure. The rest of it is spread out across other currency pairs. So I don't think that we're going to see a reversal right now, but I do think that we're going to see some disruption in that trend, and we should be prepared for it because this is where traders turn a good opportunity into a bad opportunity by allowing that disruption to really whipsaw them to death. So they tighten up their stops and they pay their brokers a bunch of spreads and a bunch of commissions, and they walk away with having done 10 or 15 trades where they probably should have only done 2. Okay, so just follow-up question on the VIX. You can actually, if you go to www.finance.yahoo.com, you can get it there. They have charts there. They're free. You can pull it up there as well. Stockcharts.com, profit.net. Yeah, that's another good one. So www.profit.net. They have some nice Java charts that are free. And the symbol there, if you want to use profit.net, for example, I know the symbol there is $VIX. But a little experimentation, you'll typically find it pretty easily. Any other questions before I have to end? I'm coming up to the end of my time period here, but just wanted to make sure I didn't have any other questions I wasn't answering. So yes, the VIX measures put and call options on the S&P. It does. It measures. It actually measures implied volatility levels on the options available on the SPX, which is the index option on the Standard & Poor's 500 index, index maintained by the CBOE. And what it is that it basically measures price inflation in those options. That's what implied volatility really tells you is are those options going up in value, and what would increase the price of an option? I mean, if we break this down to just pure supply and demand, if there's no underlying price change, what would increase the price of options across the board? Demand. So if traders are trying to buy options all of a sudden more than usual, then the price of those options is going to inflate. It's just like anything else. It's going to inflate. And options are particularly sensitive to supply and demand. And the reason why this particular option contract is such a good measure of fear is because demand for those options goes way up when traders are very uncertain because they use it to hedge their market exposure. So if they feel like that the market is going to go down or go up big or just big price ranges that would be difficult for them to handle, they'll buy options to offset that risk. And as that traffic increases, you also get the other side of the equation is the people selling the options become nervous that they're going to have a bunch of liability, so they are less inclined to provide supply. So supply kind of dries up a little bit, and how do you increase supply? You raise the price. So it's kind of a double whammy. When both sides are getting nervous, prices go up to try to induce both sides to actually meet in the middle. It's what the Fed doesn't want the market to do, but it happens very naturally in the options market. So what's my trading style for these volatile changes every day? Well, you know what? This is a good question. It's a little bit off the topic, but I don't think too much. I'm a big believer that technical analysis, fundamental analysis, etc. They're independent of time frame, and so I typically am looking for big moves, which means weeks at a time, several days, big stop losses that I don't ever get stopped out, and it's because my stop losses are so wide. The reason why I do that is that I don't want the computer thinking for me. I decide when I get out of a trade. And if I'm trading the daily charts and I'm anticipating weeks in a move, so I'm accounting for the fact that the market could move against me quite significantly or for me quite significantly, then I'm not as nervous about I don't have to be as jittery about setting stop losses that are gonna get me out. So I think a good example is I'll show you a current trade that this is not advice or anything. I'm just giving you an example, okay? Right now I'm short the euro and have been actually since the breakout here. Now I'm drawing a blank, but it was underneath a $1.50. But as the market goes down, and I'm still not out, my stop loss is currently up around 146. So that doesn't mean that I'm going to wait until the market gets to 146 to exit if I get a reversal. It just means that I've got some protection here against a catastrophic market event. So it's, I'm a big believer in being a conscious investor, not an unconscious investor. So I'm not a fan of letting the computer do your thinking. I see stop losses as protection against catastrophic issues. So anyway, that's my point of view, which means that I'm making trading decisions on as to adding a position or taking a position off. I'm taking my time to make the decision off of as much information as I can, and then making a commitment to the market, if you will. So staying in for a while. And what that means is that the subsequent moves are 1,000 pips to the downside, for example, and in one trade. So I only paid one spread, but I'm willing to give up a lot if the market retraces. So I hope that answers your question a little bit, but it's probably it's probably the thing I feel the most strongly about as far as traders. Having been on the other side of the equation, I can tell you that I know what goes on in the trading desk, and I can promise you the thing that kills traders is probably the biggest scam out there is trailing stop losses. And I always get slammed for saying things like that, but they are good for one party. and that's the dealer. So be really careful about how you use stop losses and what kind of time frames you trade. That's my biggest advice. Okay, well, I'll close here, and if anybody's got any follow-up questions or would like to chat, you're welcome to send me an email. And in the meantime, thanks everybody, and I hope I'm sure the day promises to be plenty exciting with lots of volatility. Keep in mind what I'm saying. So if we get a little bit of retracement over the next week and a half or so, we'll start to look for where the market might reverse and subsequently where it might go. So thanks everybody. I appreciate it. Talk to you soon.